Quick lunch there going on there. Early lunch. What have you got? A churros. It's not a churros. What have you got there? Just a croissant?
No, those are biscuits my mom made me.
Very nice.
All right. Hello, everyone, and welcome to the Finimize Pro Analyst Monthly Roundup. Now, if you haven't noticed, we are trialing a new format for these monthly sessions, but the agenda remains the same. And to just give you a quick overview of the agenda, first of all, we are going to touch on the particular research pieces that we have published for the month. Then we will provide a performance update on all our research, how the trades are doing, what's the averages looking like, and so on. And then finally, we're going to dedicate a lot of time going over all the questions we got from our pro members. So on hand is me and Russell to do just that.
Hi.
Now, as I said, we are going to touch on, January's research, and we produced two new research pieces or two new live ideas. So the first one is on South Korean stocks by Russell. Really interesting opportunity there. And actually, I saw the news today that the Kospi index has hit the 5,000 mark, which was the target set by the president. So great call on that one, Russell. And then second of all, on a retailer, yes, not an AI stock, a retailer called TJX. And that's the one I did. And without further ado, I'll just give a very quick overview about this one. So as always, you can find the actual research piece on the Finimize app, on Finimize web, and more recently on Substack as well. But I'll just give a quick overview of this particular company and why I like it. So if you don't know TJX Companies, you might not know them by that name, but you might know them as TJ Maxx in the US or TK Maxx in the UK and elsewhere in Europe. And if you're not familiar with their business model, it's basically, very simple and it's very low tech, but it's very effective. So what they do essentially is that they buy excess inventory from brands and manufacturers at deep discounts. Then they sell it on to shoppers at prices that are 20% or up to 60% below traditional retailers. And then they just repeat. So there's no endless promotions, no coupon codes or sales gimmicks, just high quality stuff at bargain prices every single day. So they have this kind of treasure hunt experience that they do in the store. People love a good bargain. You go into their store, you see high quality stuff, top brand items, but up to 60% off the sticker price, which is very, very compelling. And the nice thing about this model is that it works in bad times and good times. So in bad times, when people become more value conscious, etc., they trade down and they flock to TJX company stores. But even during good times, people still love a good bargain, and foot traffic holds up during good times as well. And overall, the company is extremely high quality. I'll give you some stats. So from 1989, which is the earliest my data kind of went through, to 2025, sales grew every single year except in 2 years, in 1994 and 2020. And we all know what happened in 2020. Now, over that entire stretch, so you're talking, over 3 decades, revenue grew at a compound annual growth rate of 10%. So 10% average annual revenue growth every single year throughout, the past three plus decades. Net profit margins consistently high, around 8 or 9%, which is very high for the sector. Return on invested capital of 22%, which is really, really attractive and way above the company's cost of capital. It has a fortress balance sheet. It generated positive free cash flow every single year for 3 decades straight, including in 2020. And then finally, a very shareholder-friendly management team. So they pay and grow dividends, and they've been doing this for more than 4 decades. And they've repurchased shares every year since 1998, with one small pause in 2020, because again, we all know what happened in 2020. Now, it's a very high quality stock, but of course, as you would imagine from a very high quality stock, it doesn't come cheap, right? People are paying up for quality. But to quote, a line from a very famous investor who you will know, Warren Buffett, who said, "It's far better to buy a wonderful company at a fair price than to buy a fair company at a wonderful price." And in this particular case, TJX Companies is a fantastic company trading, in my opinion, at a fair price. But what I really love about the stock is how it can essentially act almost like an AI bubble hedge. So TJX Companies, if anything, it's the anti-tech stock, right? It doesn't need, it's not investing in, same day delivery, AI chatbots, AI recommended, search recommendations and all this stuff. The business is refreshingly analog, not digital. So TJX Companies is literally sitting out of the digital arms race. Online sales, they account for less than 2% of its revenue. So it's really a brick and mortar retailer that's doing a fantastic job at, old school stuff, essentially. And actually, if you look at the stock price, and if you look at the correlation with the tech-heavy NASDAQ index over the past 6 months, the correlation has literally been zero. So basically, that means TJX stock moves independently of the NASDAQ. Also, if we look at a great analogy, the best analogy we have, or the best kind of moment in history to compare, what's happening today with AI and so on, and bubble fears is the dot-com bubble, right? And when the dot-com bubble burst, the NASDAQ dropped over 70% between the start of the year 2000 and the end of 2002. But TJX stock virtually or nearly doubled over that same period. So if we look at, a historical parallel, the dot-com bubble, TJX stock outperformed massively the NASDAQ after the dot-com bubble burst. So if you are worried that we are, currently in an AI bubble, it could burst. If you own a lot of tech names, even if you don't own single stocks, if you simply own the S&P 500 or the NASDAQ, these indices are, really concentrated in the tech sector. I honestly encourage you to diversify a bit out of tech and to consider this particular stock, which, like I said, can really help, cushion the blow should the AI bubble burst, add some diversification to your portfolio because the correlation with the NASDAQ is zero, and ultimately improve risk-adjusted returns. Now, like I mentioned earlier, that was one of the research pieces. The second one is on South Korea. So without further ado, I'll hand over to Russell to walk you through that particular piece.
Hey, thanks, Reda. Super interesting there. Yeah, I like although I'm a bit of an AI fan, having an AI hedge always seems like a good idea. So yeah. So you can see that the Kospi index is trading around just about 10 times PE based on this year's earnings. That's despite its 75% rally in 2025, and it's up almost around 18% already in 2026. And the reason why the valuations have stayed cheap is because earnings for its two big heavyweights that count for more than 40% of the index, Samsung and SK Hynix, have been roofing up. Its share prices have been driving the index higher, but the valuations have stayed low because those earnings have been so strong. And that's all because of their exposure to memory. Memory pricing and demand has gone through the roof because of AI server demand. So that's all the big spenders that you kind of have in AI. They're all trying to get their hands on memory, heading off to Korea to try to get supplies in. It's why Micron share price has been up a lot, and others like SanDisk too. They're all part of this memory trade. It's like the hot part of AI. And these companies trade cheap. They trade cheap for two reasons. There's a Korea discount because of bad corporate governance, which the government is trying to kind of change with a value up policy and try to put in new rules and regulations to improve corporate governance to get rid of the so-called Korea discount. And the other reason why these companies are cheap is because memory's been a very cyclical business. Memory demand has typically been driven by PCs and mobile phones, and that's a notoriously cyclical business. It goes up and then demand drops away, and then prices drop. And really, where if you've got high volatility and really cyclical troughs and peaks for a company's earnings, you don't pay a premium valuation for that. They always trade cheap. That's what cyclicals are. Totally unlike a TK Maxx. So, but what's happening is suddenly with the demand from AI putting it through the roof, it's leading to sustained demand and not enough supply. You can't just bring on supply that quickly. It takes a couple of years to build factories. And with the demand going through the roof, pricing has gone accelerated sharply higher. There's a report in the main docs which shows you DRAM prices, how they've just basically more than doubled in the last X months, and up 5 times from the beginning of last year. The price increases are sharp, and that's obviously what's driving the profits up. And the key part is of why Korea looks interesting and memory stocks keep moving up it looks like for the rest of 26 and probably a good part of 27, as long as the AI trade keeps working, demand for memory is going to stay strong, and therefore these profits are going to stay high. And arguably, it's not such a cyclical, well, it's a cyclical business, but the cycle is going to be much longer and stronger than usual. It's not quite structural demand because it may not last for 5 or 10 years, but definitely for the next year or two, the outlook looks pretty rosy. And that's one of the reasons why I added some career exposure to the Finimize portfolio.
Super fascinating. And yeah, I'm completely on board with the concept of, diversifying out of, stocks or AI stocks that have done incredibly well in the US and trying to find, the next AI winners outside of the US. And I think you highlighted, yeah, a great opportunity here in South Korea. Okay, amazing. Thank you so much. Next up, I'll just give a very quick, performance update. So just a quick recap that you can always find, a weekly updated performance tracking sheet, the Google Sheets that, all of you hopefully have a bookmark to. It shows every single trade that we have out there, whether it's open or closed, what trade open date, trade close dates, and how it's performed. And so far to give the latest numbers. So across 35 different trade ideas that we've put out since we started, Finimize research, which was in late 2024. Our average absolute return in annualized terms is 42%, but perhaps more importantly, our average relative return annualized, so relative to each trade's respective benchmarks, is a very strong 21%. So basically, on an annualized basis, all the Finimize trades have outperformed their benchmarks by 21%. And of course, we have a hit rate of 83%. So that's the percentage of ideas that have made money. So far, so good. And it's, I'm very proud of the Finimize portfolio performance. Now, next up is community questions and answers. And thank you so much to everyone who submitted their questions. We definitely got a lot, and we will try to answer all of them. Yeah, it's a very good question, especially after the strong run that we've seen last year. And the best way to summarize my view is I'm still optimistic, but I would be more selective in this particular environment. So let's start off with Intel. Intel has been, on fire. It was, I think, the first or the second research piece we actually put out there when we started these in late 2024. And I made the case that it was, basically undervalued. And the stock was trading at around, $22 at the time. But as of today, it's about $50 actually. So it has more than doubled. So that's worked out really well. Now, if you recall, in about October last year, something like that, I basically ran the numbers again, my sum of the parts valuation, and basically Intel had reached my fair value. And I had officially, for the Finimize portfolio purposes, closed the trade. But I did say, quite importantly, at the end, which is I recommend people to, take some profits, but to keep some money on the table for Intel, because I still believe, the price, and this normally happens if you think about it, the price overshoots what is fair value. Momentum is really strong. Momentum investors are piling in. And of course, there's, a lot of speculation that they're going to announce a deal with Apple or AMD, which will really kind of boost the shares. But valuations are looking a bit high at the moment, but this is always the case when you have, someone that undershot, basically, their valuations tanked. It was way below fair value, and then now it's kind of overshooting essentially. But I would still have, if you're on that trade, like I recommended before, I would take some partial profits and keep some money on the table. Make sure you put a stop loss, or what's called a trailing stop loss, a stop loss that progressively goes up and up as the stock, or if the stock continues to climb higher. Now, just to touch on some other names, just also caveat, I haven't done deep dives on these particular names, but I'll just give some quick thoughts. Personally, I wouldn't chase Nvidia here. Honestly, I just see too much competition. competition from some, other names like AMD and Broadcom, etc. But I think the bigger competition that maybe people should be paying more attention to is actually from big tech firms themselves. So big tech firms, if you think about Google, Microsoft, Amazon, etc., they are all starting to design with a lot of success actually their own custom chips. If you look at Google's TPUs, they have been a massive success. They used them to train Gemini 3, which has received raving reviews, and now also Google are basically getting external clients for its TPUs. So I see a lot of competition for Nvidia, again from other kind of established chip makers as well as from big tech firms themselves. So I'd be quite wary about chasing Nvidia here. If I look at some of further back in the supply chain. So if you think about TSMC, which manufactures chips as a contract manufacturer, and then ASML, which makes the necessary chip making equipment. Personally, I quite like TSMC. I think it's a winner no matter whose AI chip designs are the best. So whether Nvidia has the best GPU, whether Google has the best GPU or Amazon, it doesn't matter. All these firms use TSMC to manufacture their chips. Don't forget, Nvidia, AMD, Google, etc., they design the chips, but then they go to TSMC to manufacture the chips. So regardless of who has the best design, who has the most, efficient chip, etc., TSMC is a winner because they are going to be the ones that are going to end up manufacturing those chips. ASML is a really good company and it has a monopoly on, the best chip making or the most high-tech chip making equipment out there. But for me, so if you think about it, TSMC, let's say TSMC produces 100 chips a year, just for the sake of simplicity, because that's the current annual demand. Every single year, they produce 100 chips. Let's say each one, they sell it for $10. Again, very simplified example. They produce $1,000 every single year, year in, year out. And their capacity, they can only produce 100 chips a year. Now, if they want to increase their capacity, maybe demand is going up, and they want to expand their capacity to be able to, manufacture 120 chips a year instead of 100. So they want to increase that 20%. Then they go to ASML, they buy the necessary chip making equipment, and then they, expand their factories and so on. So the thing with ASML, it's a bet that annual production capacity will continually increase, which it will increase, but it's going to slow down dramatically at a certain point. However, betting on TSMC is essentially a bet that, look, this company will produce X amount of chips every single year, year in, year out. And to me, it's just a much more stable revenue stream versus ASML's much more bulky revenue stream, which is basically a bet on new manufacturing facilities. Now, to be fair, chips have become a national security issue, and a lot of countries, not to mention China, the US, are trying to have their own homegrown chip manufacturing industries. So currently there is a lot of demand for ASML's equipment. But of course, like most things, in the stock market, it's reflected in the stock price, right? I think it has virtually doubled over the past few months. So that's why I'd be a bit wary about chasing ASML over here, whereas TSMC, I like it. It's a very high quality company and it's a winner regardless of who ends up winning the AI race. Now, of course, you just need to, watch out with investing in any of these chip makers that if we do have an AI bubble burst or if we have some breakthrough AI models that require way less compute, then these companies will take a hit. And of course, like I mentioned, it's really good to diversify away from just, these particular names. And, Russell has made, a great case for diversifying into memory chips. So of course, when we're talking about Nvidia, TSMC, Intel, etc., they're predominantly manufacturing, logic chips, but memory chips are, becoming the next big bottleneck for AI, as Russell already talked about. And I would also, I have a positive view, like Russell, on memory chips as well.
Yeah, well, it's an interesting one. And for sure, the recent performance has been a bit disappointing. It's still almost doubled from when I first mentioned it and we stuck it in and we put it in the Finimize portfolio, but it is about 35% down from its October highs. I still like it and it's a live position in the Finimize portfolio. Right? Demand for data centers is still outstripping supply by some margin. And Nebius's plan is to bring on significant capacity over the coming years. Last quarter, in its last quarterly update, it basically said it sold out everything it's brought online, and that's just typical of where the demand is right now. It needs to fulfill this and kind of execute well. And it is a challenge to bring this capacity online. To give some numbers here, its plan is to connect 700 megawatts of power in 26, aiming for $7 to $9 billion by the fourth quarter in so-called annualized recurring revenue. And that's up from only $600 million currently. So like that's more than 10 times its sort of like revenues it's targeting there. And it's also aiming for like $13 billion kind of come at the end of 2028. So it really has ambitious plans and it needs to execute it. Next update we're going to get at its earnings, and if things look like they're heading in the right direction and it's executing well, then the share price should sort of have another move up. It's also worth noting one of the reasons I like Nebius is from the beginning was its strong balance sheet. Yeah, it's got basically no debt. It does have some convertible bonds that it's issued, but it's got a whole bunch of assets on its balance sheet. Its biggest one is a 28% stake in ClickHouse. And that was valued at $6 billion, the company was, and NBIS's 28% stake was worth about $1.8 billion in May last year. It's apparently raised new funds at a $15 billion valuation. So that sticks Nebius's stake at a value of about $4 billion. The market cap of Nebius is only about $24 billion. So, that stake alone, aside from the other stakes it's got, an AV ride, which is an autonomous vehicle thing, it's got other businesses going on as well, and that's going to help finance its expansion plans. Now, there's a couple of things that have been weighing on its share price. One, it may be, but we're not sure. It announced last year what's called an at-the-money offering of 25 million shares, and we're not sure whether it's actually accessed that, and that could be weighing on the share price. And the other reason why the AI kind of data center bubble kind of got a little bit fearful at the end of last year was concern for these so-called neo-cloud companies, which is Nebius, IREN, and the others, is the upfront capex that's needed. And, when's the cash flow kind of come through? Question marks about depreciation for the GPUs. Is it economically viable to keep spending the money and set up these AI data centers? And that was pushed by Michael Burry, and it got a lot of profile. And there's been question marks about, can Oracle spend the money? Can OpenAI afford to spend it? And one thing that's come out this week, which isn't the first time we've seen it, is OpenAI is apparently looking to raise $50 billion, putting the company's valuation at $750 billion. And that $50 billion it's going to be spending on AI data centers and the like, and help a lot of these, the spending keep coming through. As for the GPU depreciation, secondhand prices of GPUs and usage are still holding up pretty well. And Nebius uses a pretty conservative 4-year depreciation cycle. So, the chances are that the workload from so-called inference, which is the doing rather than the learning, should give these GPUs life after 4 years. That's kind of what the hope is. There's obviously risks involved, but right now I'm still a fan of Nebius and also the other names, which kind of like IREN and Core Scientific. They've all got slightly different dynamics going through here. So one doesn't fit all. IREN has the power assets, which Nebius is trying to sort of acquire. And so that puts IREN in a strong position there, but it doesn't have the balance sheet. And Core Scientific, which is reliant on CoreWeave, has CoreWeave a $10 billion contract from CoreWeave over the next 12 years, which is huge. But the question is, can CoreWeave actually afford to kind of do the rollout? So there's a lot of moving parts with cash flow, depreciation, earnings, demand, supply. And I'm watching it closely, but for now, remaining as an AI bull, it's there. But the timeline for profitability is a few years out. So they are going to have to execute well, but net, I'm still optimistic about them.
So I am of the view that bonds always hold a place in someone's portfolio. And the big debate or the big question to solve is, what percentage of your portfolio should be in bonds, which of course will be different to someone, far away from retirement versus someone in retirement. But I personally do believe that bonds should be in everyone's portfolio because I'm a big believer in a well-diversified portfolio. I'm not just talking about diversifying into like different geographies, etc. But if you think about the most high-level way to diversify, it's across different asset classes. So basically having a portfolio made up of stocks, bonds, commodities, gold, real estate, a little bit of crypto if you're into that, etc., etc. Because the only free lunch, as they say in investing, is diversification. That's the only free lunch that you have. Now, I would encourage you not to just look at the performance of bonds in isolation, but to really look at them at how they move in relation to stocks. And one of the big reasons why bonds are put in portfolios is because they tend to be at least inversely correlated to stocks, in the sense that when you have a big kind of stock sell-off, bonds tend to go up in that environment and they tend to cushion or offset losses when the stock portion of a portfolio is doing well. So adding bonds to a stock portfolio can really increase its diversification and ultimately improve its risk-adjusted returns. Also, you mentioned that, you've been looking at the performance, and if you look at the performance of bonds over the past 5 years, which I think is what the question alluded to, yes, they have performed terribly, but don't forget, over 2022, 2021, 22, and 23, we had the sharpest, the most aggressive series of interest rate hikes in history, or at least in decades in many countries, as a response to the COVID inflation shock. Higher interest rates, destroy bonds. And I would say, this environment that we saw over the past few years where bonds did really badly because of how aggressively interest rates were raised is more like a outlier than like something very common, okay? Like every maybe 3-4 decades, you would see something like this. But otherwise, if you look over a much longer time frame, if you look over the past 3, 4, 5 decades, bonds have actually performed really well. And again, most importantly, they add really important diversification to your portfolio. Now, to answer the last bit of the question, if you're very far away from retirement, yes, theoretically, right? Theoretically, if you're 40 years away from your retirement, 100% stock portfolio makes the most sense, right? That's what history would tell you, because stocks have generated the highest historical average returns. But the big question to you is, can you handle a huge investment drawdown? If you see 100% stock portfolio that suddenly drops 50%, and we've seen many times in history, the dot-com bubble burst, the global financial crisis, where stocks dropped 50, 60, 70%. Are you able to comfortably sit on your chair and keep on holding on to this portfolio? This is your retirement portfolio, and you suddenly see 50% of it wiped out. That's the big question, right? And that's why usually we don't go 100% in stocks, because even though it makes sense on paper, if you're very far away from retirement to hold 100% stocks, your behavioral impulses will really affect you and your investing strategy dramatically when you see a huge loss or when you see a lot of volatility, and you'll end up making some wrong decisions, selling at the wrong time, missing the rebound, etc. That's why adding bonds can help you with that aspect, because like I mentioned earlier, they can help offset losses, cushion the volatility, and ultimately make you more likely to remain invested, which is the number one kind of secret to generating good long-term returns. Time is your best friend with investing because of compounding, right? And the best portfolio is the one that you can stick with during good times and bad times. And if that's not 100% stocks, then it's probably a portfolio made up of stocks, bonds, as well as other asset classes, commodities, gold, etc., etc.
Thanks, Reda. There's one thing that's probably worth adding here. What percentage of bonds should you have in your portfolio? You've got strict ones like 60-40 portfolio, this and that. But a rule for you said a young person, it's the question sort of asked, is you can put what your age is as a percentage in bonds. So if you're 20, you could say 20% of bonds. And the older you get, let's say you get to 90, you don't want to have a 50% drawdown because you may not be around enough to kind of see the rebound. So if you're 90 years old, you could say, I want 90% in bonds. And kind of that sort of is an easy way to think about it.
Yeah, sure thing, Sean. So Stefan could not make this call, but I did talk to him before and I asked him this question, and he basically recommended that you roll over the hedge. And personally, I completely agree with that. I think in this particular environment, we're talking about record high stock prices, extremely elevated stock valuations, a lot of concentration in tech and the AI theme, specifically, lots of geopolitical risks. I think this is an environment where if you are heavily invested in stocks, it makes a lot of sense to hedge. And personally, to answer perhaps the question on how to hedge or protect against the Finimize portfolios, well, I'll tell you what I do, which is very similar to what Stefan has outlined. Basically, using puts on the Nasdaq, or specifically a Nasdaq ETF, the QQQ. And the way I usually approach this is really a function of the VIX index. So if you don't know what the VIX index, they call it the Wall Street's fear gauge. It's basically a measure of implied volatility. Or you can think of it as the higher the VIX is, the more expensive it is to buy downside protection, okay, on US equity markets. Now, the long-term average of the VIX is around 20, okay? And the basic rule of thumb I do, just to simplify things, is that if VIX is below 20, that implies that, buying downside protection is cheap relative to history. And in that particular scenario, I would just simply buy outright put options on QQQ, on the Nasdaq ETF or the S&P 500 ETF. But in this case, I prefer Nasdaq because I'm more worried about an AI bubble burst, and the Nasdaq is a much more tech-heavy index than the S&P 500. To be fair, both of them are tech-heavy, but the Nasdaq is more. If the VIX is higher than 20, that tells me, buying downside protection is more expensive than history. In that case, I don't buy outright put options. I do, and Stefan has talked about this a lot, what's called a bear put option spread. That basically involves simultaneously buying and selling a put option on the index. More specifically, you would buy a put option with, a strike price over here, and then you would sell a put option with a strike price lower, essentially. And the good thing about doing that is because you're buying and selling put options, even if the VIX is high and downside protection is expensive, because you're buying and selling simultaneously, that kind of cancels each other out, and that gives you good downside protection, but without paying an arm and a leg essentially for that downside protection. So that's kind of how I approach my hedging. And if I have outright put options, because I bought them when the VIX was below 20, when I see these big spikes, big sell-offs, the VIX goes to 25, 30, etc., then I would start to kind of take profit on some of those hedges. And this is super important because put options, if they expire out of the money, then the market value is going to go to zero. So it's very important with your hedging is to also know when to take profits on those hedges, because you'll see very frequently with buying put options, they'll spike with a sell-off. Amazing on paper, you've managed to offset losses. But then if things rebound, and this is the environment we're in actually, people are buying the dip, and whenever there's a sell-off, this week was a great example of it. Usually things are rebounding quickly, and then obviously your put options will dip in value. So it's really good, and it's a very good kind of discipline to have. It applies to options or even in stocks, etc. Is to take at least partial profits when positions go in your way. So high level, that's how I approach hedging.
So it's obviously a topical question and a good one. Last year in 25, international stocks generally outperformed US ones for the first time. And with that US dollar falling about 10% against a basket of currencies, that also kind of made better returns for US investors. And if you're invested in US stocks, it really was a detriment for like foreigners to buy, US stocks too. It was an extra headwind that you had to kind of cover. So the reasons for that, which are, several, but really geopolitical risks, concerns about the Fed's independence, would the president let the Fed kind of keep rates high without inflation? They started to weigh on the dollar and all the talk of US exceptionalism. And also it came down to valuations as well. Valuations finally mattered, and it, as Reda said earlier, diversification actually paid. And it actually paid for the first time in 25 for the first time in a while. And there's a few things going on there that are probably worth highlighting. One, it's not only in the US where you can get AI exposure. I touched on Korea earlier. Reda's talked about TSMC. That's obviously a big name in Taiwan. And in Europe, you had Greece, Spain, and Poland sort of leading the European indexes. And they were up, like, I think, all more than 50%. So that was kind of what's there. And these countries were all started at very cheap valuations. One issue now that you kind of have to think about is all stocks globally are trading at high multiples relative to history. And that's obviously a concern, but whilst earnings growth keeps going, then that's okay, but diversifying away from the US makes sense. So the question is where else to go? And a lot of those factors that were impacted 2025 performance sort of still remain relevant sort of right now. We've still got uncertainty about the Fed with the new Fed chairman coming in. We've got the dollar still under a little bit of pressure. China for AI, it's got very strong AI and robotics. They're kind of, second behind the US with tech. We've talked about Korea and Taiwan again, so that looks good. But when you look at earnings growth, the US still looks good. It's estimated S&P 500 earnings growth is meant to be about 12% in 26. Europe's is 5%, Japan 9%, and Asia ex-Japan around 19%. So diversification is good across all those countries. It's going to give you slightly different angle and sort of it's going to give you that diversification. So all those countries look good, and a split between developed and emerging makes sense. And then when you kind of think about which other sectors outside of tech, obviously with the geopolitical concerns that sort of touched on before, the defense sector, globally, you can find exposed to that, whether it's in Europe, Japan, and the US. There's global leaders involved in defense spending and beneficiaries there. And the other angle, which is happening with the weak dollar, we've seen precious metals, gold and silver were huge in 25, and they've started off 26 just as strong. And it's not just gold and silver, it's the base metals too, with copper. And this shift to real assets with concerns about fiat currencies and devaluation of fiat money, that's kind of the shift to commodities. As Reda said, it's all part of diversification. And you can find exposure to those companies in the metals and mining sector or materials. So that's another area that seems to make sense when you're looking at different sectors.
So I'm not sure if you meant halving your equity exposure. So let's say hypothetically 20% of your portfolio is in equities and you halved it to 10%. Or if you literally mean 100% of your portfolio is in equities and you halved it. And George, if you're 78 and 100% of your portfolio is in equities, I think you should have halved it years ago, to be honest. Because assuming that this is a portfolio you rely on to sustain your retirement, it's a lot of risk you're taking on essentially by being all in on equities. Because, if you're all in on equities, a big drawdown, like I mentioned previously, 50%, etc., could easily happen. Especially, and you alluded to this, we are kind of late cycle market dynamics, valuations are high, index concentration has never been higher. The US stock market is really relying on one theme and one theme only, which is AI. And of course, geopolitical risks are on the rise. So yes, I think it's definitely reasonable and prudent, especially considering, your age, your focus on capital preservation. A 50% equity allocation, or let's say halving your intended allocation, still keeps you participating in upside while reducing your downside risk. And also lowering your US exposure, I think makes a lot of sense, just given its recent dominance and its concentration risk. So, Russell already, talked about, South Korean stocks and so on. Now, just some kind of quick things I'll add to that as well. An alternative isn't also just, reducing equity, but being more selective with equity. So trying to focus more on, quality names, income names, and defensive stocks, which is why, I really was excited to, do a research piece on TJX because it's a much more defensive company. And then other things you can consider if you have, an equity allocation, but you don't want to necessarily sell out. Two things. One is, a trend filter. So our analyst Stefan has talked about this a lot. So basically a very simple mathematical mechanical rule to basically assess whether, stocks are in an uptrend or in a downtrend. And if they are in an uptrend, you remain invested. If the rule tells you it is now, or stocks are now in a downtrend, you basically sell and go into cash. And it's a good way to try to, it won't get things perfectly right. There's no perfect market timing strategy or rule out there. Otherwise, we would all be extremely rich. However, this is a good way to avoid those very, prolonged bear markets essentially. And then the second way is, and we already touched on this as well, is through hedges. So if if you have 100% in equities and you want to hold that portfolio, but you don't want to necessarily time the market and so on, well, you can continue owning equities, but consider buying hedges. So basically buying put options, like I alluded to, depending on whether VIX is high or not compared to history. Then you can do outright puts or put bear spreads essentially. Because to your point, it's 1%, but these things can easily go up 2, 3, 4 times when you have a very sort of violent sell-off, and you can see that offsetting, your equities. Probably actually, if you're 100% equities, I'd put a little bit more than 1%. So I think I'm 80% invested in equities now if I think about my portfolio, and the rule of thumb is I target around 1% weight to these hedges. The thing to bear in mind is that, with options, you have to pick an expiry date. So if you pick something 3, 4 months out, then you're going to have to roll that over. So you have to factor that in. It's not like a 1% and it's one off. Like at some point you have to, sell those options and then, buy options further out. But also hedging, is not something you should permanently have. I think it's also a function of the market that we're in, right? If we have like a very violent sell-off right now, right? The AI bubble bursts, Nasdaq drops 50, 60%, and then you go in or you're invested at that particular point in time. I personally wouldn't hedge. Like after 50, 60%, drawdown, for example, the valuations are a lot more reasonable. There, for me, now less things for me to be worried about. What is hedging? Hedging is protecting yourself, if things go wrong. And if you look at the world right now, there are many things that can go wrong, right? In markets and so on. But if we were hypothetically in a different market environment where, the risks and the valuations were not that high, then maybe you don't need to hedge at all. I just think it's wise in this particular market environment, but, I'm not an advocate of always having hedges on. I think it's a function of the environment that we're in.
It's a super interesting question, and I kind of differ a little bit with Reda's views, or which he was talking about earlier, but not totally. But at least for the next 12 to 24 months, I kind of think Nvidia's moat looks durable. What happens in 4, 5, 6 years' time, I'm not so confident about, because there's obviously threats out there, and Reda explained with the hyperscalers kind of coming through with their own assets, and AMD's trying to get there. But for now, the moat looks durable. Yeah, it's got this full stack platform, GPUs, networking, and software offering, and that's really helped build its competitive advantage. And it kind of locks in customers to its ecosystem, so it makes it very costly to kind of switch. So that's for now, and then again, later this year, it's due to launch what's called the Vera Rubin, and that's again going to extend its performance leadership and power efficiency. The talk is it's going to reduce the token cost by up to 10 times and cut the number of GPUs needed to train by 4 times compared to Blackwell. So I think Nvidia's still got something to offer. It's only gone up about 6% in the last 6 months. So the valuations haven't moved too much. It's trading around 24 times sort of this year's earnings. So that's not expensive. And I get Reda's points 100% on the hyperscalers building. And as he sort of said, TSMC is the one that they all go to. So it may be the better play on it. But there is this issue of capacity constraints. TSMC can't manufacture enough for everybody. There's a thing. And that's why they announced sort of earlier this month, in 2026, they were going to up their capex by 30% compared to 25 to about $54 billion. the numbers being talked about here are huge. So yes, Nvidia's margins may come under pressure at the margin, but it's still core to everything that's going on out there in terms of chips and spend and AI. And so I still think its leadership's there. And at 24 times, the valuations look okay. So I'm still kind of optimistic on its outlook. But talking about portfolio construction and how to best go about it, it's difficult. You know, as I said, Nvidia's only up 6% in 6 months and Google's up 75%. And, you know, if you're in the wrong name, that kind of hurts. So the way that I kind of like to go about it really is you kind of have broad-based coverage between, you know, in the QQQ for or a tech fund, take your pick, and then try and cherry pick round the outside on the side. So, you know, that Finimize portfolio that we've kind of talked about a few times, we've kind of been on this AI trade with nuclear, neo clouds, data center spend, China AI. We're kind of there, memory more recently. We're kind of there on top of it. So that's the way that I kind of look at it. You should have a core kind of exposure and then try as and when the market moves and the realization comes, there's a new hot area to jump on, then kind of, you know, get that little bit of extra, you know, fun in your portfolio from those names.
So silver has quite interesting supply and demand dynamics and quite different to gold. So roughly 70% of silver supply is actually a byproduct of extracting other metals like lead, zinc, copper, and gold actually. So very different supply dynamics. On the demand side of things, so 22% roughly of silver demand is things like silverware and jewelry. But here's the key thing, around 60%, so the bulk, is actually industrial demands. So basically, because silver has a great ability to conduct heat and electricity efficiently, it can react to light in certain chemical states, and it can be stretched into thin wires and rolled into thin wires without breaking. It gives it this kind of triple threat that makes it a very in-demand metal for things like in fast-growing electronic segments, actually, like solar panels, batteries, LED lighting, flexible displays, touch screens, RFID tags, cellular technology, water purification, and just to name a few, okay? And since most of these products only need a little bit of silver in them, manufacturers really, don't feel the pain too much when silver prices go up, okay? Because and they certainly won't be looking out for alternatives because they only need a little bit of silver in these applications. So if the price goes up a lot, the ultimate impact on their cost to manufacture these things doesn't go up that much because again, the silver requirement is quite low. So there's attractive supply and demand dynamics, obviously, right? And supply is a bit constrained. Like I said, there's very pure, silver mines. It's a byproduct of producing other things. So the best way to kind of summarize it, so unlike gold, which is predominantly viewed as a precious metal, silver is widely viewed as a precious metal and an industrial metal. Okay, and that hybrid nature means it is both sensitive to economic activity and investor sentiment. Now, having said all that, personally, I'd be a bit wary about chasing this rally. Like, I'm sure you all are aware, silver prices have gone hyperbolic, have done much better than gold over the past year. I mean, both have gone up amazingly, but silver has been in its own kind of bull game. And for me, my favorite kind of rule of the thumb, valuation metric to look at the both of them is to look at the gold to silver ratio. So this is, a particular ratio people have been looking at for a very, very long time. Now, the gold to silver ratio, basically very self-explanatory, compares the price of gold to silver. And right now, it's basically 51 times versus a 30-year average of 68 times. So that basically tells you silver prices have gone up way more than gold prices. And on a relative basis, now gold is more attractive than silver. I don't know if any of them are attractive in absolute terms, to be quite honest, just considering the crazy run up that we've had. But at least just purely looking at the ratio, it says, silver is starting to look overpriced compared to gold. And just to add to that, you touched on silver mining stocks, but actually there's very, very few pure play silver mining stocks anyway, if you wanted to get exposure to those. because, like I mentioned, producing silver is usually a byproduct of producing other metals. So the cleanest way to get exposure is through the commodity itself. Things like futures, but I wouldn't recommend that unless you have a very big portfolio size because one contract represents a huge amount of notional value. But silver ETFs, right? Just the simplest way to get exposure to silver prices. But again, I'd be hesitant to chase this rally right now.
Yeah, I'd just add to that one, Reda. Yeah, I mean, I'm with you. I think from what I've been hearing, there's a lot of hot money in the silver trade in a quite a big way. And one thing that's really different between silver and gold is central banks have been the big buyers of gold. So, and that's sticky money and they're going to stay there. There's this whole diversification outside the US has been going. It's central banks diversifying away from US dollars into gold. And that's kind of a different demand side to it. But yeah, I mean, I don't have a strong view. I still like gold myself, but I don't have a view on silver at all. I mean, to go crazy is trying to guess one sector to go crazy in the near term and the next. I mean, really, to be honest with you, it's we could guess, but it's not really. Yeah, I'm not sure. I actually, separately and Reda to kind of go down this line's kind of a little bit silly. I am a fan of memory stocks, but they've already gone crazy. So trying to figure out what's going to go crazy next, I just don't really have a strong opinion. Yeah.
We've done a good job at trying to find sectors that have gone crazy before they went crazy. So obviously nuclear, for example, AI, Russell, in your case, the neo clouds and so on, memory, uranium, to name a few. But
Yeah,
I
It's true.
don't know
We
what I
try.
would. To your point, a lot of these sectors have already gone crazy. That's getting kind of harder to find the next crazy sector. There's a lot of talk about quantum computing, but if you look at the stock prices, they've gone absolutely crazy. I don't know. Data centers in space, perhaps. That's one thing I'm hearing about. But
Space, look, you've definitely got, but the space stocks as well, they've already gone up so much. You got
exactly.
ASTS, whatever it is, up 100% already this year or something. I mean, I don't know. With Duncan to answer, we're going to be looking to see what we think is going to go crazy and try to kind of get it out as and when the opportunities arise. So yeah, there's one company that still looks really interesting. I covered it more than a year ago, and it continues to perform well and execute. It's called Transmedics. It's a medtech company. What's interesting is transforming the organ transplant market with what it's called the Advanced Organ Care System (OCS), and it's got its own logistics network that it's been building out. It's not a big company, only around $5 billion market cap, just under that actually. It's a quite simple concept to understand. Organs like heart, livers for transplants used to be kept on ice, literally, but that had serious limitations for how long the organs could stay viable outside the human body, which is needed when they start getting shifted from one location to the other, ready for a transplant. And this OCS uses warm perfusion, which kind of mimics the human body, and so the organs can last, depending on which one, for up to 24 hours. So that means more transplants can happen, and also at favorable times of day, which are more suited to the hospitals or the surgeons doing it, because they don't have to do operations at 3 o'clock in the morning. So net, it's a bit of a win. And it's growing rapidly. It's about 30% revenue growth for 2025 and targeting like at least mid 20s for the next few years. It's got decent gross margins at around 60%. And it's developing new of these OCS for heart, liver, and lungs. And it's also kind of trialing one for the kidneys too. Its market primarily is in the US right now, but it's just started expansion into Italy and plans to expand further in Europe. And this kind of talk of expanding in Asia too. The stock's up 10% this year and up over 140% over the last 12 months. As long as the growth keeps coming, I think, and the outlook still looks good, it's definitely a company that I still like from here. And it's still got that position in the Finimize portfolio.
Yeah, so look, the big thing to think about is the impact of tariffs and inflation. And basically, if tariffs push inflation higher, then the Fed would really face a policy dilemma, right? So either they have to hike rates to control, prices versus risking stress and growth and kind of debt servicing, because this is the problem as you alluded to. So actually, the US national debt currently exceeds $36 trillion dollars, and the debt to GDP ratio is over 120% at the moment. But the big problem is the debt servicing costs. So essentially, how much the U.S. government is spending just on interest. And actually, interestingly, the U.S. is now spending more on interest payments, alone than its entire defense budget. So basically, interest expenses running at almost or approaching $1 trillion annually. So now the big problem is, if tariffs lead to higher inflation, the Fed keeps interest rates higher for longer or increases them, that creates a really tricky situation because higher rates in a higher debt environment basically increases the fiscal strain, raises the risk of policy volatility. And one key point to also be aware of is actually refinancing needs. So I can't remember the exact statistic off the top of my head, but a quite significant percentage of the current US government debt needs to be refinanced in the coming year or two. And if the US government has to do that at right now much higher interest rates than were available just a few years ago, that's also going to increase the interest burden and the debt burden, because the more the government has to pay on interest, the bigger its deficit is. So if you think about the deficit as the gap between the government's revenue and its expenses, if the expenses piece of the pie goes up because you're paying more in interest, that gap widens. And how does the US government, like most governments, finance the gap? By issuing more debt. But you issue more debt, you pay more interest on it, your interest expense goes up, the budget deficit widens, forces you to issue more debt. And you can start to see very quickly how this can end up becoming a pretty bad spiral. Okay, so with that, we've managed to go through most of the questions. Thank you once again for everyone who submitted their questions. And thank you for watching, and be sure to tune back for our next update next month.
Yeah, thanks for listening, and until the next one.